Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. One of the day's sessions was a look at Fidelity Tactical High Income Fund with portfolio manager Adam Kramer and institutional portfolio manager Scott Mensi. Adam and Scott reflect on how the fund offers the potential for income and capital growth through investments across a broad spectrum of income-producing securities. This is accomplished by having the flexibility to invest where the best opportunities exist, being unconstrained by asset allocation profiles or benchmark weightings. These opportunities originate from a wide range of income-oriented asset classes across the yield beta spectrum. Stay tuned to learn more. This podcast was recorded on May 30th, 2024.
I should mention that Tactical High Income also is now available in an ETF form. So Adam, I'd like to start with you. And as we like to mention, Adam is a good Canadian hailing from Montreal. And as I joked with Scott and I found out last night, his kids play hockey and his father was the dentist for the Hartford Whalers. For those of you that go back for NHL history sites, said that makes you close enough to Canada, so we're good. We're all good there. So Adam, I'd like to start with you. 10 years, it's been a great run. Can you maybe just walk us back? How did we think up this fund? How did it come to be?
Yeah, thank you. Thank you very much, and great to be here. And it was great over the last couple of days to meet so many of you and hear how you're using the fund and take your questions. So thank you very much for all your support over the years as well. It really is hard to believe that it's been 10 years. It's gone by very quickly, and we'll talk about how we've made modifications to the fund, how we've improved it, how we think about the fund today. But really, at the end of the day, when we came up with this idea 10 years ago, we were basically just listening to the customer. I mean, that's basically what we were listening to. I'm part of many great asset allocation strategies at Fidelity, many of which I'm on the team, some of which I'm actually managing. Many of them are using a strategic benchmark. What we heard is that we wanted to have the investors wanted to have something with more flexibility, the flexibility to invest across the full spectrum of income-oriented asset classes without a benchmark, but with tight risk parameters, and do so from a bottom-up security selection, where we're taking the best ideas from all our strategies across every single asset class, and having a lead manager such as myself taking the fiduciary responsibility to determine what goes into the funds. That gives us a very flexible mandate, allows us to adjust to the times and to compound returns and get a premium yield. Now, in our group, the group that I've been in for the last 24 years, and also Scott as well, the High Income and Alternatives Group, we were able to hit the ground running. For the last 24 years, we've been rating companies, not only the stocks, but also the bonds, the high yield bonds, the floating rate debt that have collateral against them, convertibles, preferreds. We have a team of really specialized research analysts that are going through all the legal documents. And when they're coming up with an opinion on the company, they're not just rating the stock, but they're rating every single part of the capital structure. So for us, it was very synergistic to be able to put this together, get the best ideas. And like what we like to say, we like to find the sweet spot in a capital structure. Where is the best risk reward? Now, the raison d'etre of the fund, the philosophy also as to why we put this together is that, if you look back over 25, 30 years at all the major income-oriented asset classes, it's something other than bonds and it's something other than equities that's usually the top performer. More than 50% of the time, it's something like a high yield bond or a preferred stock, a convertible bond, emerging market debt, real estate income asset class that actually is the best performer. So if we're looking at these asset classes on a regular and consistent basis, we're able to capture a lot of return and premium yield that other investors are not capturing on a regular basis. And that's why we have had a competitive advantage with the prowess that we have at Fidelity.
Very exciting. Adam, I was hoping you could take us back with yourself a few years. So I mentioned it was Montreal, I believe, born and bred. So how did you wind up at Fidelity?
So I'm from Montreal, still have family there. I also have family in Toronto. I'm Canadian, also American citizen as well. And I always used to collect hockey cards. That's how I really realized that I have the passion for tracking stories, tracking investments. And I actually went to McGill and I became an accountant. I'm a chartered accountant by trade. And I realized I wanted to, do this for a living. And so I went back to school, and then I started at Fidelity in 1999 as a summer intern in this high income and alternatives group that I spoke to you about, and then started full time in 2000 as an analyst. And I was an analyst rating the entire capital structures for the first 8-9 years, covered around 15 different industries. And that's how I cut my teeth and eventually became a portfolio manager. Now I manage this fund, but I also manage all the convertible bond strategies at Fidelity, the preferred stock funds at Fidelity. I'm an asset allocator with my other co-manager, Ford O'Neill, who we'll talk about today, on multi-asset income strategies. And we also have a state of Massachusetts mandate that was the original tactical high income fund for many years.
So from summer intern to running a show, very impressive. Scott, let's go to you.
Sure.
Obviously, there's a lot of moving pieces in this product. The thing that always amazes me is just how many resources you really pull into this product. Can you talk to me about how do you decide what PMs to work with? How do you decide to allocate their sleeves once you do pull them in? What does that process look like?
So if you look at our calendar on any given day, you're going to see a lot of recurring meetings. So these can be meetings with analysts themselves, so the folks that are looking at companies. It could be meetings with analysts that focus on geopolitical things or inflation. So we have these ongoing discussions that are happening across Fidelity with these experts, but we're also meeting and talking as a team. So Ford O'Neill, which Adam just mentioned, Ramona, who was up here earlier, they're all invited to these discussions, and we sit down and we go through and talk with all these managers, and analysts. What are your best ideas? Where are you seeing value? Where are you seeing income? What are the great stories? And that's where it starts. It starts from the bottom up perspective, because this is what's really different about this fund. And Dave, you said sleeves, but I always correct folks when they say sleeves, because we don't use sleeves, right? So when we invest in high yield bonds or loans or investment grade bonds, we're picking the individual securities. And that's really different because it allows us, one, to be a little bit more nimble, right? We're not pushing money over to sleeve managers. They have to invest it. But what I like to say is when you use sleeves, a sleeved approach, and it's fine. This is just a little bit different. What happens is that manager, if let's say we have 15% that we want to put in high yield, we have to send it to Harley Lank, who runs our American High Yield Fund. He takes that money, he puts it into a strategy. He's trying to beat the high yield index. So what happens when you manage to an index? You have to own pieces of that index because it's a part of that index. Not because you like it, because it's a big part. That's what I call index filler. And doing the single security approach, we can avoid the filler and really focus on the team's best ideas. So that's what's really unique about this strategy. Using the different pieces, whether it's from investment grade fixed income up in Merrimack, our equity team, our high income and alternatives team, all the folks at Fidelity, we can find the best ideas within each of these strategies and put them into the portfolio rather than owning things just because they're part of the index.
Adam, can I get you to expand on what Scott just said? So that all sounds great, but you've actually made it work. And to Tara's point, you've created unbelievable alpha for the portfolio. So what does sort of the process work on when do you decide to go all in on somebody? When do you decide to pare back? How is it you've created basically all of this alpha over a 10-year time period?
So first of all, you mentioned the team. So we have a great team. Ford O'Neill, who is a very seasoned fixed income analyst. I think he was runner-up for the Morningstar Fixed Income Manager of the Year just recently.
And I think he won it a handful of years ago.
He won it a handful of years ago. So he offers all his expertise on anything related to investment grade bonds, emerging market debt, macro as well. And Ramona Persaud, who spoke earlier on, is my co-manager as well, and she offers her expertise on anything equity income. And I have been, as I mentioned, focusing on all the other different asset classes throughout the many years, and we have our pulse on all these markets. When you put the three of us in one room, as well as Scott Mensi, you have the full spectrum of income-oriented asset classes represented. So that really makes for a rich conversation. The starting point is always, what are the co-managers? What are their best ideas in their portfolio? So on many occasions, Ford has given me a call. A couple of instances, a couple of examples would be right after the investment grade bond market crash of 22. We were in a conversation in one of our regular meetings, as Scott was alluded to. He says, Adam, these are the 10 investment grade corporate bonds of the blue chip companies that I'm buying in his total bond fund. take a look at them, get familiar with the research, and I think these should be in the portfolio. They were yielding 7% for 5-year duration. Before COVID, before the sell-off in 22, the yields were much lower. You're getting good risk reward. So that's how the ideas come. And it's the same thing with Ramona. I'm always familiar with what her best ideas are in her global equity income fund, her equity income fund in the United States, what she's doing over here. And we have our conversations, and she's always introducing what her best ideas are as well. Of course, it's my fiduciary responsibility, my decision as to whether they go in the fund. But that's the input. Then you have all these other meetings that we have as part of this mosaic. I mean, we're not trying to make predictions as to which way the economy is going to go. We just want to make sure we know where we are in the business cycle and try to assess whether or not asset classes and securities have too much or too little good news priced in relative to what the market thinks. So we're meeting with our inflation analysts once a month. It's a repetitive conversation. Our business cycle analyst, I know Urian is going to be speaking afterwards. We have a Friday meeting. I'm listening to Urian. All the asset allocators are in that group as well. David Wolf, David Tulk, etc. So I'm listening to what other portfolio managers are saying. That's an input as well. And then it's very synergistic because we do this fund, but I'm also managing the convertibles, the preferred shares, the high yield bond stock, the high yield bond portfolios, the fixed to floater preferred portfolios, loan portfolios. So I have my best ideas in all these asset classes. So when you put that together, you really only need 15 to 25 or 30 of the best ideas of every one of these asset classes to really put together a diversified portfolio, but get that security selection impact that a lot of the funds don't gets diluted sometimes in a very large portfolio. I'm also an asset allocator on a bunch of strategic funds in Canada, one of which is the Strategic Income Fund here in Canada, which is basically 5 different bond income asset classes. We have sub-managers there. I'm speaking with them. I know what their best ideas are. We're having conversations regularly. Those inputs come into the fund. And then in the United States, we have something called the Strategic Dividend and Income Fund, which I co-manage with Fort O'Neill. There we're looking at infrastructure stocks, master limited partnerships, commodity equities, inflation-protected securities, real estate income. We're meeting with all these different sub-managers, and so we're getting their best ideas as well. So this is just a very synergistic process, a day-to-day process with conversations. And as we get to know the people, to your question, we can gauge whether or not they're getting more conviction. When you're speaking with somebody on a regular basis, you can gauge if they're getting that more conviction. Are they banging the table a little bit more? And that really helps with the process. It's a continual process.
Sorry, Scott, I want to go to Adam, but can I ask you a follow-up question? Do you think it helps the fact, like you mentioned that you started as an intern? Lots of these colleagues that you're working with have been at Fidelity, I'm going to say the same amount of time as you were, a long period of time. Does it help when everyone has such long tenure that you know each other, you know where to go, you're not meeting people or learning things for the first time? Does that help you in this obviously very complicated process?
Well, I think, yeah, of course, it definitely does, because when you look at even the high income and alternatives group at Fidelity, the president of the division, Harley Lank, he started his career as an analyst. You look at all the high yield bond portfolio managers, including Adam, all analysts before they were portfolio managers. The loan managers, the same thing. Obviously, Adam on the convertible bond fund and his co-managers there, all analysts before they became portfolio managers. And that's important because when you look at what we do, and Adam talked about it earlier, we rate that full capital structure of the businesses. And a lot of our competitors, when they say, okay, we have our fixed income analyst, the analyst will be rating a specific sector and they'll cover the investment grade part of the portfolio as well as the high yield bond part of the portfolio of the market. And there's very different drivers for investment grade bonds and high yield bonds. I'd argue high yield bonds are more equity-like than investment grade bonds. So that's a big difference in terms of our philosophy, in terms of finding that sweet spot in the capital structure, which is definitely beneficial for us, because when you look at these major income-oriented asset classes, you can get those equity-like returns potentially from fixed income, if you're in them at the right time and know the companies, know the risks. But, a lot of people think that, bonds are just investment grade bonds and treasuries, but things like high yield bonds, convertibles, preferreds, again, they can get equity like returns. And what do I mean by equity like returns? I mean, high single digit to low double digit returns. You can get them in those asset classes if you're looking at them at the right time and understanding the different dynamics of each of those markets.
Yeah, we like to say we're trying to do more with less, more equity like returns with less equities, less volatility, and with premium yield. That's the key thing. That yield has been half of our return. And even when you take out I'm talking about the 5-year number now, but if you take out the income component, we're still above the category and many indexes as well.
Does everything have to pay income? Like, does every stock has to be a div payer? Would you have something in there that was not?
For sure. I mean, historically, we've been in the 90s with regards to income securities in the fund, but duration and credit spreads get priced in many different ways. And it doesn't have to be an income-producing security. For example, small cap and mid cap stocks were selling off because of duration fears and credit fears. I mean, it was just that's sort of what was an obvious area that maybe was pricing in a lot of bad news in that respect. So it doesn't. And if we can, we like to buy a bond to dovetail it with it, sort of make it into a sort of a quasi dividend payer.
Got it. Kind of complement it.
Yeah.
A question for either of you. Talk to us about the guardrails that you play within. So, and what are your guardrails, and then how, I'll say, close do you play? Do you play right to the guardrails? Do you generally stick in the middle? What kind of movement do we see?
So I'll start off, I guess, with that one, and then obviously, Adam, you can chime in. I think when we look at the guardrails, those are important, but I think you have to, before we start getting into the guardrails, you have to think about what are we benchmarking ourselves to? And while this fund doesn't have a stated benchmark, what we use to track our performance and risk profile is a 50-50 split of the S&P 500 and the investment grade bond index in the US. So what's different about what we're doing is that that's not the universe that we're picking from, right? We're going well out beyond that. So that benchmark is really a risk bogey, right? So what we want to do in the strategy is we want to wiggle like that 50-50 index over a full cycle, but use the flexibility that we have to invest in other areas of the market that have better risk reward than, let's say, traditional stocks or investment grade bonds. So that's kind of how we think about it just from an overall portfolio perspective. And then, a lot of folks have asked us over the years, well, how do I know that you're not going to be over your skis in risk when it comes to equities or high yield bonds, or have too many treasuries and miss out on the upside? And we limit ourselves. We look at forecasted risk metrics such as beta, tracking error, and we have specific ranges that we need to be in. So for beta, for example, it would be 0.75 to 1.25. Our forecasted 1-year beta has to be in that range every day. And if it's not, we make adjustments to the portfolio. So over a full cycle, you probably get a beta profile of around 1. So that's one of the metrics. And then when we think about the amount of stocks that we can have in the portfolio, we try to limit ourselves to in between the range of 30 to 60. Historically, we've been 40-ish, 42, 43. So that's really underweight equities relative to a traditional balance fund. We also have limits on what the duration can be in the portfolio relative to that 50-50 index, again, to make sure that we have that proper tracking. And then we also we have maximum underweights that we can be relative to the largest names in the S&P 500. And that's super important, especially when you start to think about environments like today, last year, when you have technology, the Magnificent Seven, really moving higher. And again, those really aren't our cup of tea when it comes to what we're looking for. But we want to have that tracking, so we'll own them. So those things allow us to keep up in environments like we see today. And that's one of the things we've changed and evolved in the process over the years, where 2017 was a very similar year from a performance perspective, with stocks leading the way and investment grade bonds being the worst, and technology being a big part of that. And what we found was, our stocks did okay, but the strength in a lot of these technology names really hurt us on a relative basis. So what we've done since then is implemented those rules. And what you've seen happen over the last couple of years, particularly 22 and 23, we've been able to keep up a lot better because we've implemented those rules. So you look in the top 10 of the portfolio, you'll see NVIDIA, you'll see Amazon, Microsoft. And that's really, we're severely underweight those names relative to the 50-50 within our limits, but they show up because we want to give you that proper tracking. We want to have that risk profile. But at the same time, when you look at that top 10, you're going to see things that are very un-S&P 500-like, and that's the differentiator.
Yeah, and Scott mentioned two of the key rules. The third one is to have enough income to dampen the blow in the down market for bonds and equities. And we're always seeking a premium yield relative to that 50-50 benchmark we're talking about. Could it be double? Yes. Could it be hundreds of basis points higher? That's sort of where we have been in the past. But having the proper matching of income to the amount of duration risk you're taking on in the investment grade and credit market and in the equity market, that proper match is probably the key differentiator. Because single asset class funds and many balanced funds that we're competing with do not have that income to dampen the blow in the down markets.
That's a perfect lead into my next question, which is, with this amount of fixed income, how important is it for you to have a view on inflation? And I'll say, is it a big deal? Is it not a big deal? How much time do you spend on that? And actually, I'm stretching to connect these two, but I do think it's important because the conversation our clients here are all getting a lot of is also, how much do you pay attention to the election in November? Is that something that you pay a lot of attention to, or not so much?
Mm-hmm. So we're always cognizant of where we are in the business cycle, where inflation is heading, those sorts of things. You have to be aware because that plays into how you view valuations on a relative and historical basis. But the key to navigating all these different times that we've seen, if you look over the last 10 years, we had COVID, we had an interest rate crash, we've had a couple credit crashes, some stock market volatility, obviously. And the thing that's allowed us to perform really well is having enough income to dampen the blow. So if we have that proper matching, we can have a view on where interest rates or inflation is going, but that really shouldn't matter if we have the portfolio constructed in a way that income can offset the potential downdraft that could come from either the bond side of the portfolio or the stock side of the portfolio. So that's a key component. We certainly have views on where things are going, and maybe I'll let Adam talk a little bit about his views on inflation and interest rates. But if we're doing our portfolio construction right, we should be an all-weather strategy, and I think that's what we've shown over the last 10 years.
Yeah, Ilan Colette was on stage before, David Wolf. We're having these discussions all the time. Which way is inflation headed? So we're always cognizant of what the situation is. But what we found over the years, year in, year out, like clockwork, every single year, there's an asset class that prices in something well beyond the events occur, and so. We're always, that's what's so great about the strategy, with having so many different asset classes that we can keep an eye on it, have a view, but the opportunities just keep on coming our way. What's the next asset class that is pricing in too much bad news? Where is it? What asset classes or what securities are pricing in real yields continuing to move higher? Where rates continuing to move higher because the market's assuming that inflation is going to go up, versus other areas that are pricing in a mid-cycle. And it's the narrative always changes, and we're just looking security by security. With the election, it's something we're keeping an eye on. I know we were asked that a lot yesterday. I've heard a few people ask it today. It's definitely something that could create volatility. I think there's positives and minuses on both sides, and we'll just wait to see how things pan out and what opportunities come. But again, like Scott was saying, if we're choosing the right securities brick by brick in the portfolio and have enough income to dampen the blow in the down markets, if the bad scenarios don't take place, you can really get an equity-like return, with much less volatility. And give you just a hypothetical example. If you have a 4% current yield made up of dividends and bond income, and you're getting that every single month in dividends, approximately net of fees, 4%, and you're only taking on 40% equity sensitivity, and let's say 3-year duration, that 4% is enough to offset, the first 10% decline in the stocks, if that were to occur, and then you'd be stuck with just with the bonds, of course, which with a 3-year duration is much less than an investment grade duration. Every 100 basis points would equal 3%. But if bad news doesn't take place, you're going to get 4% from current income, 4% from the capital appreciation from stocks, and then 3% from capital appreciation from bonds. That gets you over 10%. With much less volatility than the equity markets, and that's where this whole matching comes into play. It allows us to really sort of just navigate the best ideas.
Now, you mentioned things with bad news priced in. Let's take the opposite of that and talk about AI. How do you have to have a view on this? It's obviously these are very growth stocks right now. But how do you view it just in, I'll say, changing the world, changing our business, perhaps changing in some of the companies that you invest in?
Yeah, the one thing I would say is that we've definitely at Fidelity been on top of this theme, and it's been a very good investment theme. I have a bunch of co-managers in the high income and alternatives group that I work with on other strategies that have a lot of top ideas in that area. And one of the like Scott said, we force ourselves to own all these names in the S&P 500. But if you were to compare us to the benchmark or a traditional 50-50 fund, we'd be considered underweight. But we force ourselves to own them to give you that risk profile that you see in a 50-50 fund. What we've been trying to do is find the best ideas that don't have too much good news priced into them. So there's a lot of derivative themes that we've been looking at. I mean, number one, we keep on hearing that artificial intelligence requires a lot of electricity. There's a lot of utilities, many unregulated utilities that we're trading at, single-digit enterprise value to EBITDAs, some of which we're yielding. We like to look at free cash flow yields in our group, free cash flow yields in the 15 to 20% area that are, that had some nuclear exposure to them as well. There's a repricing secular theme that could take place on the utility side of the United States. We're seeing that already happening as well. We have to rebuild their electrification. There's a lot of bottlenecks that are going to have to get resolved. So there's a lot of derivative themes that find their way into the portfolio, whether it be a stock where we don't think enough good news is priced in, where there's a revaluation on a secular theme, or in many cases, some of these companies, these utility companies, had issued preferred shares. They had issued convertible bonds. They had issued high-yield bonds. So we could put together the entire capital structure of some of these ideas.
We've got some questions coming in. First one, how much flexibility do you have outside of the U.S., and are you finding any exciting ideas globally? So I'll take that as outside of the U.S.
Sure, I'll start with that one. So we can go anywhere. The hard limit on non-U.S. would be it's 35%. Over the history of the fund, maybe we've gotten to 8 or 9. The issue with adding a lot of international, particularly when you buy the local currency, is if you think back to what I was saying earlier about risk budgeting, forecasted metrics, when you start to add currencies in there, that really eats up a lot of the risk budget. The models will see the volatility in the underlying currency, and that kind of that adds a lot of volatility, even if it's a small position. So that's why we tend not to have a lot of international exposure in the portfolio, but there is some today. And I think, what I alluded to earlier in terms of that single security approach, by having that approach, we can really just hone in on some really specific parts of the international market. For example, emerging market debt. If you've seen the chart of our allocations over time, we haven't had a lot there, but we talk with the emerging market debt team within our group, and we'll ask them, what are your best ideas? And the one idea that we continuously heard from them about was Petróleos Mexicanos, which is the state-owned oil company in Mexico. And that was only, 1% or so in the portfolio. But because we use it as, we didn't buy a sleeve of emerging market debt, we just bought that one. Even at that small size, back in 2022, that was one of the top contributors to performance. So when we do it, we do it very thoughtfully. We've even owned the Brazilian sovereign over the years in small amounts. We've owned some international stocks as well, Asia, Europe, and even Canada. So they're in there, but again, they're going to add a lot to the risk of the portfolio because of the underlying currency.
Yeah, we've historically been in the 90s with US centric, but whenever there's opportunities around the world, we will put them into the fund. And we do have, being Canadian, I always used to invest in Canadian funds. There's a nice Canadian flavor in the fund as well. If you look in the top 10, you'll see a few names in there. Out of Pizza, A&W, Royalty Trust. We've had those in the fund for quite some time.
So our good fast food brands.
Yeah, yeah. So and they pay income every month. Yeah.
Let's go to the next question here. What are your thoughts on high yield bonds, and maybe throw in their leverage loans as well, just while we're on the topic? Yeah.
So we're talking about areas where a lot of good news is priced in, and I think if folks looked at spreads in these markets, they would say, yeah, there's maybe too much good news priced in. I think when we first got here, high yield bond spreads were just right around 300, which is close to their all-time tights. But that being said, I think what's different now versus other periods when we've seen those spreads that tight, particularly post-financial crisis, the yield now in that market is still pretty high. So let's call it 7.5%, 8%. on high yield bonds, and about 100 basis points more when you start looking at leverage loans. So one of the things we look at really closely when we are thinking about outlook, what could happen in the market, and doing all the worrying that we do, is the health of those markets. And for the most part, we're seeing some pretty strong performance, obviously, out of the asset classes, but the amount of distress that we're seeing in those markets is still pretty low. So we look at one thing called the distress ratio of each of those markets. So how many of these companies are at levels where you would anticipate they default within the next year? And those numbers are still small on a relative basis and historical basis. So that gives us some comfort there. And while valuations are tight from a spread perspective, that yield component, we can, again, avoid those areas that are really, really priced for perfection and focus in on our high income alternatives team's best ideas within the loan and the high yield space, where we can get 7% current yields, 2 or 3 year duration on the high yield side. If we think about that proper matching, what that means is if you have a 3 year duration and let's say interest rates go up 100 basis points, again, not our best, base case scenario, our credit spreads go up 100 basis points. With a 3 year duration, that would mean a negative 6% return potentially on the capital, from capital appreciation on the bonds. But if we've got that 7 or 8% yield, that more than offsets that. So that's a good matching of income to the amount of risk we're taking on from a duration perspective. And then when you start talking about leverage loans, there we have very little duration, and the coupons now are even higher, 8-9% in some instances. So that's again, a really nice balance of income to the amount of duration risk. And obviously the real underpinning factor is the credit research that we're doing, because if you're not in the right companies, you can get these attractive spreads and things can go poorly. But that's why we have that dedicated team that's looking through all the indentures, talking with management teams. One of the loan positions that we own in the portfolio, a company called Bass Pro Shops, the loan team, Eric Mollenauer, Kevin Nielsen, Chandler Perrine, they have a great relationship with Johnny Morris, who's the owner and founder of Bass Pro. We meet with them regularly. We helped fund their acquisition of Cabela's. So we really get to know these companies and can feel comfortable about their fundamental trajectory, which allows us to make those balancing acts of income to the amount of duration risk we're taking.
Yeah, and these loans, we have first lien collateral on the business if something were to go wrong. These are healthy companies as is. So when you can collect 8% floating, not take on any duration risk if rates continue to move higher, then that's a really great return. And other companies that have been in the fund for a while that have loans outstanding are companies that you probably all heard of. There's Uber. Uber has a loan that's yielding around 7% floating. There's Four Seasons Hotels. And even Manchester United, the soccer team. Yep. We have a loan against them, first lien collateral on the team. So, very interesting asset class. And if we could just, pick our 15 best ideas in that area, hold on to them for a while, it really helps.
Adam, you had an interesting comment we were together yesterday on convertibles and how you've taken advantage of those in the fund over the years. Maybe you want to just share a few stories on those?
Yeah, great question. So convertibles are, we like to say, the secret sauce of the fund. And for anybody who's not familiar with it, it's basically a bond that pays you an income, but you get to participate in the stock price. And so of all the bond asset classes out there, convertibles are the only one where you can actually double, triple, quintuple their money. And in 2020, for perspective, right now we're around 3% convertibles right now in the fund. But in 2020, we were as high as 20% because after COVID, all these companies came to the market to shore up their balance sheet. Their stock prices were depressed. The credit spreads were wide. We got great terms. And then whenever I saw a deal that I put into my convertible securities fund, if it was an overweight there, it found its way into this portfolio. So that's how we get these ideas too. And eventually the economy recovered. We all know what happens. Many of these convertible bonds were doubles, triples, quintuples. That was a huge contributor. In 2020, the convertible bond market was up almost 2.5 times the S&P 500. And then in 2022, to your point about duration, convertible bonds sold off a lot. They went down to 50 cents on a dollar. We didn't own many of them. I went out to all our analysts in our group. I said, let's all hands on deck. Let's look at all these mid to small cap software companies that issued convertible bonds that had no debt on the balance sheet. They were all cash rich. They could pay down the convertible at any given point in time. I said, which ones can we buy at 50 cents on a dollar that are worth 100 cents on a dollar in 2 years? And we got a whole list of them, and they found their way into the portfolio. We had a bunch of them that were actually taken over. The most noteworthy one was Coupa Software, which was taken over by Thomas Bravo. Overnight, our convertible went up 30 points from 70 cents on a dollar to 100 cents on a dollar. We got taken out. And there were a whole bunch of others that actually went well beyond 100 cents on the dollar. So what a way to differentiate, get equity opportunities, but not take on equity. A secret sauce, and we just wait for those opportunities to come to us.
Very interesting. Now we've only got about 3 minutes left. You've had 10 years of wonderful returns. We've mentioned, the best-selling balanced fund, 5-star, all these wonderful things that come with it. Perhaps what would you like to leave the audience today as they're going to go back tomorrow or even today and be speaking with their clients? What do you hope they take away when it comes to this mandate?
Sure. I think when we look at, and then you take a step back and we think about where this strategy came from, it came from a mandate that we have with the state of Massachusetts, and they have an unlimited time horizon because it's a pension. And what they've done with us is they've expanded our mandate over the years, given us more flexibility. And the reason why is because when we look at what's happening in fixed income markets, particularly credit markets since the financial crisis, is that the time from peak spread blowout to back to median valuation, that time period is getting shorter and shorter and shorter. So what the state of Massachusetts understands is, the time to take advantage of these opportunities is getting really small. And in a pension fund, there's processes of approvals in order to make changes to allocation and move money around. And what they've realized is that we can't do this fast enough anymore. So we'll leave the asset allocation to the experts and let you take advantage of these opportunities in these plus sector parts of the market. And I think that's what's resonated with folks that invest in this portfolio, is that a lot of times they're not investing in convertible bonds, leverage loans, maybe even high yield bonds, and leaving the asset allocation up to the experts has proven to be the right decision. And I think given the research team that we have on all of these different asset classes, obviously the history and the track record of the portfolio, I think that makes a lot of sense for folks. And, all of my children's education money is in there. I'm heavily invested in the US version of the strategy, so I'm a true believer.
And there's less reversion to the mean of total return on this fund also. Because like I said, all these asset classes take turns every year as the best and worst performer. The bad news right too long, it gets priced in, adjust the following year. And then when the risk rewards of these asset classes or these securities that we have are no longer attractive, in many cases we might get redeemed by the company, we get taken out. It's a great problem to have. In other cases, if the risk reward isn't there, we sell in a tax-aware manner. And so gains get locked in. And that's why, going forward, there's always an opportunity in the space, and past performance is no indication of the future. The portfolio today is very different how it was a couple of years ago, and that's why this is a set it and forget it total return compounder, and we'll just continue to try to do good for the investors.
Well, thank you both very much.
Thank you for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. Thanks again. See you tomorrow. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.